Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss U.S. stock market regains key level, Treasury auctions, the new market indicator. We're also going to take a look at U.S. labor market remains strong, and jump on over to the Plan Solutions Incorporated office bulletin board. Mr. Armour, how are we, good sir?
Things are going good. Yeah, always gets a little quiet in the summer. I think most of our clients are vacationing or enjoying the weather and things. So it's been a great opportunity to, catch up on some of those long-term projects that you're working on how to, continual improvement. Since you have a little bit more time to, what was they say, work on your business instead of working in the business.
Yes, sir. I know exactly what you mean. All right, well, let's dive right into our first topic. U.S. stock market regains key level. I love this, just this starting. You always have all these wonderful quotes. There's an old saying on Wall Street that the market climbs a wall of worry. What does that mean, and how is that reflective of what's happening with the stock market right now?
Yeah, a lot of these old Wall Street sayings, point out the things that are counterintuitive, right? And so that's why I like a lot of these things, because it reminds you of it's not necessarily the way you would, think of it common sense wise. And so in essence, the idea is, the market, it climbs a wall of worry, meaning when there's a lot of concerns about different issues within the market is typically when you'll see periods where the market will just slowly grind higher. We've talked about another old saying, which is the market goes up the stairs and down the elevator, right? And so that's kind of that going up the stairs portion where it kind of slowly grinds higher, even while there's a lot of concerns about, different risks or negatives that are out there. And I think for a lot of people that's counterintuitive, but if you really think about it, it makes sense, right? If you think about it on the extremes, if we were in a period where everything looked great, and there was no reason to worry about future developments, well, that's going to already be priced into the stock market, right? The stock market is, to an extent, future forward looking, but it also is kind of trend driven, especially in the short term. And so if everything is really good, the market's likely trended higher for a while. And now, hey, where do we go from there, right? Things can't really get better, but they can get worse.
Right.
And so when everything looks great, that's when a lot of people want to then jump into the market, right? Because they're like, look at how good things are, look at how good the market's done. And you think, yeah, but it's priced for perfection is another saying, and if it's priced for perfection, all you need is for things not to be perfect. And, then you're probably going to see a sell-off.
Right. Let me jump in there real quick, because we've discussed that and we've seen that, and so many situations have arisen, be it geopolitical. Goodness, I don't want to minimize anything and say small things in the news, but we've seen it where certain things have come up. It's put a mental or emotional unease, and we've seen a shift occur.
Right. And that kind of, looks at the other opposite extreme, right? If there's lots of things for investors to worry about and a lot of potential risks out there, then there's a lot of reason for investors to be worried. And they're likely to be taking a more cautious outlook as they, either anticipated those things or priced them in, and might be shifting more of their capital to more conservative investments from riskier investments like stocks. And kind of hedging in case those worries become a reality. But when there's a lot of worries and it's already priced in, then what happens if things don't come in as bad, right? They don't even have to be good. They just have to be not as bad as what was feared. And that can create a catalyst for then people to kind of rethink, okay, what does this mean? And slowly start, increasing risk and adding to stocks as they start feeling a little bit better, or maybe, less in the extreme, pessimistic camp. And that's when, the stock market may grind higher and basically climb that wall of worry.
Yeah, it's such an interesting scenario. We've been doing this podcast for 10 years, so I've gotten a nice firsthand education on how, like you said, there's everything looks good. It's sunny skies. People jump in. There seems to be something in the news or a dip of some kind. People jump out, and it seems just really not counterintuitive, but counterfactual on how it works.
Yeah, it's really just looking at reality versus expectations, right?
Mm.
And the expectations is the part that's often missing. I mean, you see that with individual companies, right? You can have a very fast growing company and they're expected to grow revenue at 50%, in the next quarter, and they come in at, 45%. You're thinking, my gosh, I mean, they grew sales with 45% in a quarter. That's phenomenal. And the stock price goes down 5%. And people say, well, why is that? Well, because 50% was priced in, right? You could argue they were priced for perfection and they came up a little bit short of perfection, and then the stock price gets hit. Whereas you can have another company, they're expected to lose a bunch of money in the quarter, right? And they come in and they lose a little bit less and the stock shoots up, and you think, well, okay, but look at how much money they lost this quarter. Why would people be buying that stock? Well, because it outperformed those expectations, and the extreme negative scenario was priced into the stock, and it wasn't quite as negative as what was expected.
Yeah. Well, let's talk about the recent market rally. What are we seeing around that? We saw some dips, gains. It's been an interesting period since last year.
Yeah, yeah, it was an interesting, first half of the year, or we're almost through the first half of the year. The S&P 500 was really strong at the end of 2024, and started this year at a level of 5881. But quickly in January rallied past that key 6,000 level, and even went higher. But then we saw it start to sell off, right? Went into a dip, went into a downward trend in April, which was largely due to a big increase in investor worries that were being priced in, right? And as you mentioned, reading the news, you name it, right? Tariffs and trade wars, the U.S. government debt and deficits, the Federal Reserve that paused their interest rate cuts that they were doing in the second half of last year, and you could add to that list. I mean, that's just kind of the big, three broad categories. So investors were pricing in a lot of those worries. And those worries haven't necessarily gone away in the past several months, but they also haven't shown up in a big way in the data.
Hmm.
So there's still concerns about down the road, but we've been getting quite a few months of data and things have held up fairly well. And so I think we're seeing the S&P 500 is climbing that wall of worry as it rebounded back into positive territory for the year. Here in early June, it surpassed that key 6,000 level again, and so far it's been holding. We'll see how that goes, but it's pretty clear the market is no longer pricing in the worst case scenario, but there's still plenty of worries. And so then you wonder, will the market continue to climb that wall of worry, or will some of those worries become more justified as we get additional data? We'll have to see how that plays out.
Yeah. And I know that, we often talk about the headline sale, and some people just simply jump to the headlines on so many different things concerning the market. So what does this mean really for the market moving forward at this point?
Yeah, I think investors need to be pragmatic. This is where probably the novice investor misses out on a lot of return because they
Mm.
focus on the headlines and the worry, and they don't think what is priced in and what is not. It's a lot of negative news. You think, okay, there's a lot of negativity priced in. Is it possible things could be a little better than that? Could they be a little bit worse? Well, what would that really take for it to be worse than expected? That might be a very unlikely scenario, whereas a kind of reversion to the mean that often happens is maybe the more likely scenario. Um, so yeah, it's really looking at, okay, the negativity that you hear really gives you an idea of what the expectations, where the expectation level is at. Now you have to think, okay, what's the realistic possibilities of different scenarios and the percentage probability that those will occur. And if you think about it that way, you may kind of turn what feels like a negative period, and next thing you know, you're kind of looking at it thinking, well, no, actually, this looks pretty positive because I think there's a good chance that the actual reality of the situation is not going to be as bad as what we're hearing, what we're feeling, what's already priced in.
Right. Right. Anything else we want to add here before we jump to our next topic?
Well, I think this 6,000 level is another thing that's interesting. There's always this maximum on Wall Street to pay attention to large round numbers.
Hmm.
They often become kind of a turning point, or you can have higher volatility around those numbers. It's kind of, I think, a natural human tendency to draw a line in the sand, right? And so you can say the bulls and the bears, the optimists and pessimists on the market. That's often a line in the sand where they really fight it out. And you can kind of stagnate there for a while, but then usually one or the other wins, and you see some bigger moves that come off of that. So I think right now is a time to really pay a lot of attention to those market trends.
Yeah. Let me ask you real quick, that sparked a question in my head. Do you think oftentimes the optimism and pessimism, maybe from someone like me, the average individual, I'm kind of a set it and forget it kind of person. I try to do as much detailed research as I can. But I'm not someone that's incredibly, active in it. But I try to, based on our conversations, not only here but privately, have a very good, solid perspective on how the market works. And some people's perception is that big gains, almost like the movie story. I found this one special thing, and here we go. It's going to take off, and that drives some of the thinking for people.
Yeah, it can. I mean, definitely the stock market for some people is more of kind of a gambling mechanism, right? And
Mm.
that does create some price distortions. And it also creates these trends where, maybe something, well, we've talked about the meme stocks, right? Back during COVID that really took off. Well, these were companies where the expectations were extremely low and it came in a little bit better. So you started seeing some positive moves, and then people kind of piled into that, and then it became this whole fad or this whole trend on social media, and then worked the opposite, right? By the end, they were so overpriced because expectations were so high because of whatever everybody was hearing, and in a lot of cases, the average person, by the time it becomes news and they're hearing about they're on the wrong end of it, right? They're not getting in lower. They're not getting in during that early part. They're getting in at the end when it's priced for perfection. And even a small stumble could lead to a big stock, decline in the stock price. Um, and vice versa. You can have a company that's doing really well and then struggles and sells off quite a bit, and by the time it becomes news because it's such an extreme event or an outlier type event, you know all that negative news is already priced in, and the question is this still a company? Is there still going to be demand for their products? If so, there's probably a good chance that they're underpriced at this level, and that going forward, the news won't be as bad or as pessimistic as what's being put out there.
Yeah. All right, let's jump into Treasury auctions, the new market indicator. I don't recall us ever talking about Treasury auctions. How does it work? What are they? What do we usually see around this? And who's really the one that's bidding in these auctions?
Yeah, I mean it's kind of a boring thing, right? It's just the inner workings, the plumbing of the financial system, if you will. Not something that generally we'd bring up, but it's been kind of interesting recently. I mean, basically the idea is Treasury auctions is how the U.S. government borrows, right?
Hmm.
They issue Treasury bonds to bring in the money they need to either refinance existing Treasury bonds that have matured, or to cover deficit spending, which we've had a lot of in the last 5 years. And so the process is, large investors, which is mostly investment banks, but, large enough investors, anybody can register with the Treasury, and they submit blind bids to the Department of the Treasury with the amount, the Treasury bonds they want to purchase, the interest rate that they're willing to accept, and a few other kind of esoteric details that we don't need to go into. And then the Treasury, compiles all of those bids and ranks them mostly, from the lowest interest rate to the highest interest rate. And they go through and they look at how much they need to borrow. So they just keep adding from the lowest interest rate, whatever they were willing to lend, and they just keep working their way up till they finally get, the total amount that they need to borrow. And then that is what sets the interest rate. So then those treasury bonds are sold to the winners of that auction, and the purchasers all receive the same terms.
Hmm.
So even if you said you would accept a 3%, but then somebody else said 4, and then somebody else said 5, and the treasury had to go all the way up to 5% to get the total amount that they needed to borrow. Even though you said you'd take 3, you're going to get a 5% bond. People that said they'd take 4 are going to get a 5% bond. So there's an incentive to bid low enough to where you actually get an allocation, right? That you're actually able to buy the bonds. But there's also somewhat of an incentive, you don't want to take too low of a rate of return just in case a bunch of other people are willing to accept a lower rate of return than you are. So it's a good way of allocating it and doing it fairly efficiently. And then what it does is it basically sets government borrowing rates through that auction process, which can have a big impact on a lot of other areas of the market and the economy.
Yeah, I mean, interesting stuff. I'm really was surprised when I was reading this that I don't recollect us touching on this. We may have, but so how does it really overall impact the market? I mean, you spoke about interest rates. What kind of liquidity does this hold, and what really, purpose does this serve not only for the investor or investors and the government?
Yeah, so usually these auctions are pretty boring because they just kind of go as you would expect, right? There's a lot of demand for U.S. government debt, both domestically and historically globally,
Hmm.
and always a high level of liquidity in those bonds. So even if someone gets, allocated a certain allotment and they want to sell, they can generally sell them pretty easily, at a reasonable price. But what's happened recently is the auctions haven't gone so well, which has created some concern, about the state of the U.S. government finances. I mean, basically the deficit and the level of debt. And in some case, there hasn't been a lot of demand for to buy treasury bonds at these auctions, or when there has, the interest rates that people are demanding have been pretty high. So we've seen some volatility around government bond rates when during these auctions. And government bond rates are generally the benchmark by which a lot of other debt is set. I mean, corporate bond borrowing rates are typically, treasury rates plus a certain risk premium. Mortgage bonds are, treasury rates, especially if they're government-backed treasury rates plus, certain risk premium, maybe for interest rate risk or, fluctuating prepayment risk, these other things that are priced in. So, if the treasury auctions don't go so well because there's not as much demand, that could push up interest rates, which then could have a negative impact on other areas of the economy, in addition to the government finances, because it means the U.S. government will be paying higher interest rates. So it is something now that, historically, like you said, we haven't really talked about it. It's been very boring. It's been kind of a non-issue, but now it's becoming a new indicator that we need to watch and see if this persists, or maybe if things settle down and it gets back to, just being this normal, boring process that we don't have to worry about too much.
But as of now, as you stated, it's kind of a must-watch financial market indicator, at least for the time being.
Yeah, I mean, on the day that these auctions are occurring and seeing where things are being priced, it is having a substantial impact, not just on the bond market, but on the stock market as well.
Interesting. All right. Well, we'll definitely keep an eye on it. So it might be a topic that comes up a little bit more frequently. Let's jump on over to U.S. labor market remains strong. For a short period, it appeared the U.S. labor market may be weakening, and we talked about that, and we've touched on it quite frequently. But now we're seeing some pretty strong indicators.
Well, and this is maybe one of those things where, expectations are very negative and then things are not coming in as bad as expected, right? Because yeah, there was an expectation we'd see a hit to the labor market, whether it's from, letting federal government workers go, whether it's companies being more cautious around tariffs and maybe, reducing workforce or at least not hiring. There's been a lot of uncertainty, and that was kind of reflected in the ADP jobs report. So ADP being one of the nation's largest payroll processing companies, they typically come out with their own jobs indicator a few days before the Bureau of Labor Statistics announces the official, government numbers for the non-farm payrolls for the nation. And the ADP report came in at just 39,000 jobs in May, which is pretty weak. So that was, something to take notice. But if you followed these things, you know that the ADP report, it's good for an outlier, once or twice a year. Either they report a jobs number that's way lower or way higher than what you see in the national statistics. So I think it got the market's attention, but everyone then was really eager to see what the official jobs report would be, and if it would follow the ADP or if this was one of those months where it differed.
Yeah, and it did because as you outline here, the Bureau of Labor Statistics releases their report just after, whereas ADP was expecting 39,000 new jobs. It blew it out of the water. It was 139,000 jobs that were
Yeah, yeah.
increased for the month of May. So that's a pretty big discrepancy.
Yeah, big difference. So I think this was one of those outlier months, and also the unemployment rate, which is based on a separate survey, held steady at 4.2%, which is a historically, solid level. So yeah, in the end, it looks like, the jobs market was pretty positive. I think that allowed the market to breathe a sigh of relief, that we're not seeing some of the weakness in the labor market that you might see if the economy was really slowing. So it maybe reduces some of that anxiety about, tariffs, trade wars, hiring freezes, things like that, that at least so far don't seem to be coming to fruition. I think arguably, if you dig into the report, you do see maybe some very slight signs of weakness.
Hmm.
Not anything that you'd get, too concerned about, but that you would say, okay, this is something we need to continue to keep an eye on. But, we may be in one of those situations where expectations are, so negative that even just an average, just kind of solid average number is going to be a positive for the markets.
Yeah, and it's really interesting how psychology can play such a huge role in this if it's the mindset is of a negative expectation, and then it's like, oh, far superseded it, when in reality that sometimes it's hard to look back, or you got to take a look at histrionics, that maybe it just stayed at a real steady course, but the way we built it up in our minds was, well, this exceeds it, or whoa, this is way below what expectations are, when in reality it might be, it's about normal.
Yeah, I always say happiness equals reality minus expectations, right? If your expectations are low, there's a good chance reality will be better and you'll be happy. But if you have really high expectations, then chances are reality is not going to live up to that, and you might have a negative mindset. And yeah, sometimes it's just understanding how to set those realistic expectations that can lead to a big shift in whether you're, viewing something as positive or negative. And in the case of the psychology of the markets, that tends to be priced in, either in the form of a rising stock market or a falling stock market.
Absolutely. All right. Well, let's jump on over to the Plan Solutions Incorporated office bulletin board. We've got one item pinned up there, and Daryl's been busy.
Yeah, Daryl recently went to the 53rd Financial Planning Association NorCal Conference in San Francisco. So it's considered one of the better conferences nationwide. Obviously, if they're on their 53rd year, they've been doing a pretty good job, and they bring in a lot of great speakers, a lot of good topics on financial planning strategies, practice management topics, and really, we like to at least have someone from the office attend these because they go learn best practices of what other people are doing, and we can assess, is that something that we should be doing as well? Should we, tweak some of our service offerings to better serve our clients? And so, Plan Solutions is happy to cover those things, but it's always on the understanding that you got to bring back a lot of notes and what you learned so that we can have a discussion and really see if we can use that information.
Absolutely. And it sounds like Daryl, in addition to bringing all that information back, got to see a really cool keynote speaker, Brandy Chastain, one of the members of the 1999 FIFA Women's World Cup team. That's pretty cool.
Yeah, and actually, I had one of the first female fighter pilots as well. What tends to happen is they have the keynotes, and they're usually kind of interesting celebrities or someone who did something unique, and they're able to apply, what made them successful to our business, right? Like, this is what I did, this is what you can do, even though they're maybe not financial experts. So those are always, really motivational and interesting talks. And then there's lots of breakout sessions where you can choose which ones to go to that typically, are more in the weeds, more technical related to our business. So they do a good job of, breaking up the content to keep it interesting. So you don't spend the whole time really technical down in the weeds. You get kind of a break and hear these interesting and uplifting speakers.
Yeah. Oh, great stuff. Anything you want to add while we wrap up this edition of the Plan Solutions Incorporated podcast?
I just hope everyone's having a great summer. It's we're working away. So if people have any concerns, things and changing in their finances, by all means give us a call.
Absolutely. Well, and we thank you for listening to the Plan Solutions Incorporated podcast. If it's your first time, hit follow on whatever platform you're on, be it Apple Podcasts, Spotify, or your preferred location to get podcasts. And if you want to follow along to a video form of the podcast and watch the financial review plays on the screen while you hear the conversation that Chase and I have, please go to our YouTube channel, youtube.com/Plan Solutions, and you can subscribe there as well. And if you would like to get the written form of all the content that we discuss here, the personal financial review, it's simple to subscribe. Send Katie an email. It's katie@plansolutions.com and get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.